Hello, I'm Russ Mould, AJ Bell's Investment Director, and welcome to Fundamentals, a new series of videos looking at the world of funds and collectives. In each edition, we'll highlight one of the most popular purchases on the AJ Bell Youinvest platform, and then analyse why your fellow investors might be buying right now. So this week, fifth on the list for passively run funds is iShares Core S&P 500 ETF, or Tracker Fund. Now this tracker is an ETF, exchange traded fund. It's designed to track or mirror the performance of the underlying assets and deliver that performance minus the running costs. This means this particular tracker is following one of the US stock market's best known and broadest indices. iShares Core S&P 500 uses physical or direct replication to generate performance, so it owns the underlying securities, which are some of America's biggest firms by market cap and indeed best known names. Apple, Microsoft, oil giant ExxonMobil, healthcare specialist Johnson & Johnson and industrial conglomerate General Electric represent the top 5 holdings. The tracker comes with an ongoing charge figure of just 0.07%, so it's very cost effective. According to data from Morningstar, only 2 products from Tracker provider Source are cheaper out of a field of over 80 peers. The iShares product is huge with over $12 billion in assets under management, so it should be pretty liquid under normal market conditions. It's also ISA and SIP eligible, and this particular instrument comes with accumulation units, so any investor buying this will have any dividends reinvested rather than distributed as cash. The tracker is nearly 6 years old and comes with a 5-star ranking from Morningstar for those investors who place importance in such things. The tracker also comes with dollar or sterling priced options, and this chart shows the performance of the sterling version since its launch, and as you can see, it's stuck to the index like glue. As a final point, by the way, iShares S&P 500 is one of the 16 members of the top tracker list used by our investment guidance service, and it represents 15% of the adventurous portfolio. So that's the mechanics out of the way. The big question now is, why would advisors potentially be buying now? Well, this is just my opinion, but there are 3 possible reasons. First, the US economy may not be, breaking eggs with a big stick, but it is doing better than most of its international counterparts. Japanese GDP has shrunk year on year in 3 of the last 5 quarters, the UK's growth has decelerated 4 quarters in a row, and Europe looks to be stalling again. By contrast, the influential Atlanta Fed's GDP Now survey expects 2.2% year on year growth from the US in Q1, an acceleration from Q4. A string of decent enough macro numbers have also calmed fears the US is tipping into a fresh recession, although nothing can be taken for granted. Further improvement in the influential sentiment surveys or purchasing managers' indices would be welcome, and it could be helpful to see the monthly manufacturing PMI go higher, given the historic relationship between that indicator and the S&P 500 itself. Second, the Brexit referendum set for June may be persuading some of your fellows to park your cash overseas, just in case the pound takes a drubbing. Sterling's already gone from $1.57 to $1.42, and that increases the value of dollar assets once they're translated back into sterling, assuming, of course, the value of the underlying securities doesn't fall even faster, and this chart shows the sterling dollar cross rate. Finally, for everything that's been thrown at it, the US market's been very resilient. At just over 2,000 on the S&P 500, it's only down 5% from last year's all-time high, compared to, say, the FTSE 100 that's down by around 12%, or Japan by nearly 20%. In addition, volatility finally seems to have calmed. More US stocks have set 52-week highs and 52-week lows for the last fortnight or so, which is a good sign, and that compares to the January carnage when you had just 3 highs and nearly 1,400 new lows, so there's a bit more depth to the market. But you would like to see highs outstripping lows by a couple of hundred or more, as they were at this time last year, to give you real confidence we're over the winter wobbles. This final chart shows the gap between new 52-week highs and 52-week lows on the New York Stock Exchange, and then it runs that gap against the S&P 500 index. Let's see how those trends develop. Thank you for watching, and I look forward to seeing you next time.